And Michael, you heard Jared and Emily kind of breaking down the numbers. Yes, the headline number was in fact disappointing, but the unemployment rate ticked down. Average hourly earnings did go up. How do you break down the data we got today?
Yeah, Jared and Emily did an awesome job breaking it down, and they really covered all the bases. But I would focus on the fact that the unemployment rate fell to 3.9%. So we're getting pretty close to the lows of the last cycle. And the reason that happened with weak headline job growth, just 199K on the headline figure, is that the unemployment rate comes from a separate survey of households. And we saw much stronger employment growth for the second month in a row from that survey, over 650K, with a 3-month moving average now for the household survey of 723,000 jobs per month. That's much more robust than the headline jobs figures that we're seeing from the so-called establishment survey. And so the unemployment rate is dropping like a stone. The other thing to consider here is that in the last cycle, when we saw the unemployment rate fall to 3.9%, the Fed was already well into a tightening cycle, almost all the way through it, in fact, and doing quantitative tightening, meaning shrinking the balance sheet. The Fed has not even moved policy rates yet. The Fed is actually still expanding the balance sheet as we speak and will continue to do so through the first quarter. So really, any way you slice it here, the Fed is miles behind the curve relative to the last cycle.
Yeah, but it does seem like they're quickly catching up, and really expectations for what they're going to do this year strengthening in terms of, it was only a couple weeks ago, we had a couple guests saying, look, I know the Fed said they might have 3 rate hikes in 2022. We don't believe it, not going to happen. But kind of given some of the strength that we've now seen in this report, you can also point to wages rising hotter than expected too. I mean, now you got some economists out there talking about 4 rate hikes this year. I mean, what is really, I guess, the biggest change and how quickly some of these estimates are changing in just the last couple of weeks?
Yeah, I think you alluded to it in the previous segment, which is that if you go back and look at the Fed's forecasts, they did not envision this kind of a rapid plunge in the unemployment rate. And in fact, the recovery has been underestimated right from the start, but in particular, the labor market tightening as rapidly as it has over the course of the last year and a half plus. And so what's happening here is the data is really forcing the Fed's hand. We have high inflation, that's a known, but this plunge in the unemployment rate, which is ongoing, I think is creating a situation where the FOMC is recognizing that they're falling behind the curve. And so even if they do raise rates 4 times this year and start to shrink the balance sheet relative to where the business cycle is, unemployment, GDP, inflation, you could still argue that they're behind the curve relative to the last cycle. The last cycle was very slow in terms of growth with very low inflation and a very gradual decline in the unemployment rate. And so that was a situation where it was appropriate for the Fed to wait a long time and then to move very slowly when they did start to move. This has been a much more rapid cycle with much higher inflation and a much faster tightening in labor market conditions. And it almost sounds like I'm quoting right from the December Fed minutes, but the minutes indicate that this is on the Fed's radar now, the rapidity of this recovery and its ongoing duration relative to the last, is why they're starting to talk about moving more quickly than what was expected, say, 6 months ago.
Michael, on the headline number, there is the question of, to what extent this latest COVID surge, the Omicron variant, could have disrupted the labor market. I mean, we're talking about near full employment right now. So, even though this data doesn't necessarily address the disruptions from COVID, I wonder to what extent you see the needle moving in any direction from this latest wave when you consider where the labor market is right now.
It's a great question. We don't know for sure. It's certainly possible that the most recent surge in infections took a bit of a bite out of that headline number. But a lot of the other data has looked strong. I mean, we just talked about the household survey, which showed over 650,000 jobs. We also see jobless claims reported weekly, hovering at multi-decade lows. So, if the variant was disrupting the labor market, you probably expect to see jobless claims moving up, and they have not yet. So it's really tough to say. It's possible there could already be a bit of a drag in the data from this surge in infections. Perhaps we'll see more of a drag in January, but I think the bigger picture is whatever weakness we're likely to see probably is going to reverse pretty quickly. And that's, I think, also consistent with how the bond market is acting here, and the Fed speaking in a more hawkish manner, I think fits the business cycle dynamics, which is if we average Q1 and Q2, there's some temporary softness in Q1 and then a big bounce back in Q2, whether it's the labor market or GDP. We should really look over the horizon a bit, I think. And if we do that, it makes sense for the Fed to be considering moving more quickly than what was expected 6 and certainly 12 months ago.
Yeah, and I guess, Michael, to wrap up here, it might be worth remembering, some of the things we were talking about earlier on in the pandemic when it looked like the economy was falling off a cliff, but stocks were still rising after that initial 30% fall off a cliff too. And everyone was saying, wait, what's going on here? And I guess it's an important reminder to kind of separate out what's going on in the economy versus what might go out in the stock market here. And really, I mean, slowing growth isn't necessarily terrible from an economic perspective outside of the market. So, I mean, when you're looking at maybe how things are shaping up now, Jared and I have been going back and forth, kind of trying not to make too much of the initial moves that we're seeing with energy and financials once again leading the way, and maybe, tech stocks getting hit because of the rise we've seen in the 10-year. I mean, how do you see that maybe continuing to persist this year as it's, it was kind of that wave back and forth last year?
Yeah, absolutely. So, you mentioned the reopening trades, the airlines and cruise lines in the previous segment. Those stocks are rallying. That's extremely good news in terms of the market looking beyond this recent surge in infections and over the horizon, higher immunity levels, better therapeutics, and a pandemic that is increasingly defanged and less disruptive to the business cycle. Now, that may not do much for the overall market because the extremely highly valued tech stocks, play a pretty big role in the major indices. And those were helped by the pandemic in many ways. And with high valuations, anything that starts to put upward pressure on market interest rates can be a problem for valuations. And that's what we're seeing play out in the overall marketplace. But that's not really a threat to the growth outlook. I think the rotation that's going on is quite healthy and tells us that the growth outlook is actually improving. But with higher market interest rates, these areas of the marketplace trading at nosebleed valuations are likely to run into some trouble. And, here we are.
Michael Darda, MKM Partners chief economist and macro strategist. Good to talk to you today. Appreciate you stopping by on this Friday.